Good afternoon, good evening, good morning, depending on where you are. Welcome to this session where we're going to look at the prospects for the global economy in 2026 with a focus on developing countries and emerging markets. Uh, Many of you will recall that this has become an annual tradition for us, the beginning of the year. We take advantage of the fact that the World Bank produces its Global Economic Prospects report in January. And we use that to trigger this conversation where we look at different elements of the outlook, the risks, the opportunities that developing countries face in the year ahead. And our structure for the hour that we have together is, as always, we are going to begin with a presentation by Ayhan Kos. Ayhan Kos, no stranger to these events. He is the director of the Global Prospects uh, department at the IMF, at the World Bank, I should say, my mistake there. And Ehan is also the deputy chief economist. Ehan's team produces this report, so he's going to take 15 minutes to walk us through the main messages coming out of this report. Then we're going to have a conversation that will involve him, but we'll also bring in three other experts looking at different aspects. We have Joyce Chang, who's going to be joining us. She's managing director and chair of global research at JP Morgan. So she'll bring a perspective not only from the markets, but from really 30 years of experience working on emerging markets in developing countries. We have Abe Selassie. Abe Selassie is the director of the Africa department at the IMF and has been leading the IMF's work on all the countries of sub-Saharan Africa. Abe has recently announced that he will be retiring from the IMF soon. So great for us to be able to capture him while he is still there. And then Liliana Rojas Suarez, who is also a veteran of these events. She is, of course, a senior fellow here at CGD and the director of the Latin America Initiative at CGD. So that's the structure. Let's start now with Ayhan, who's going to use some slides for his presentation. Ayhan, welcome to you.
Thank you, Masood. Are you able to see me?
You're looking very professional, so off you go.
Wonderful, thank you. So let's start with the presentation. Shannon, can you put the presentation up? Okay, I think presentation is also up now. Okay, so thank you, Masood. It's wonderful to have this event with CGD. We treasure this tradition. We released the Global Economic Prospects report. As usual, the report has the global and regional outlook chapters. In addition to those two, there are two important chapters. One is on frontier markets. We basically launched that at CGD London office. That was very successful. So I'm not going to discuss that today, but there is another chapter very important on fiscal rules I would like to talk about. So there are three important messages I would like to convey today. The first one is basically the global economy is broadly stable, but there are still serious downside risks. Second important message is fiscal rules work under certain conditions. And the third important message is especially emerging market developing economies need to focus on their policies to generate jobs, to promote growth, to increase resilience. With that, let me start with global outlook. So what do we see? There is this term we use quite often, resilience. Resilience basically refers to how good the global economy has been in terms of absorbing shocks, trade tensions, geopolitical tensions, extreme policy uncertainty, the types of things, one shock after another that hit the global economy. But you see here global growth pretty much remain steady. And we think that that will continue this year, actually. Growth will be around 2.6, 2.7%, exactly what it was before in 2025, for that matter, 2024. So advanced economies led by United States, especially the superb performance of the US economy, delivering strong growth around 1.6, 1.7%. You look at the emerging market developing economies, there you see a slowdown at the back of mainly China. If you take out China from the sample, that slowdown is not necessarily noticeable. And there, a number of actually countries are doing well. For example, India delivering very, very strong growth. So what happened? Despite all these trade tensions, extreme policy uncertainty, these trade tensions did not translate into the type of, very high tariff rates announced last April. And global supply chains have been remarkably resilient. Firms have been remarkably flexible, and financing conditions remain accommodative. In fact, interest rates went down. Energy prices were quite low. So all of these things help basically the support the recovery. Now, this resilience does not mean dynamism. When you look at the growth numbers, they are much weaker than what we saw in the 2 decades before the pandemic. So we used to see growth around 3%. Now we are happy growth is around 2.6%, but we don't have crisis. In emerging market developing economies, growth tend to average around 5%. Now we are basically seeing around 4% growth. Now, this is the big picture when it comes to global growth in the near term. What we did, we looked at the advantage of 5 years after the pandemic. It's a good time to think how this global recovery from the 2020 global recession is different than previous recoveries following the global recessions of 2009, 91, 82, and 75. Now, first, the good news. Despite all the shocks, this global recovery, if you focus on per capita growth, has been the strongest global recovery we have seen since 1960. And you see this on the left. Of course, the global recession was very deep, but the recovery was very strong. So that is good news. And that happened at the back of advanced economies. You look at advanced economies per capita income, pretty much in all of them, higher than the per capita income prior to the pandemic in 2019. But there is a striking and equally disturbing divergence in the sense that when you look at emerging market developing economies, 1 out of 4 of them ended up basically remaining poorer than 2019. If you look at low-income countries, that number is around 40%. If you look at fragile and conflict situations, 60% of them today poorer than they used to be in 2019. And of course, this has huge implications when we think about convergence and getting close to income levels of advanced economies. In fact, for emerging market developing economies, things somewhat steady. But if you take out, major economies like China and India, there is not much convergence. If you look at low-income countries, they are today, relative to advanced economies, 10% poorer. Fragile and conflict situations, they are 20% poorer. So this recovery for the global economy after the 2020 pandemic global recession was a great recovery. It was a recovery of rich countries, and it ended up being a very bad recovery for poorer economies. There are important risks, and those risks center around, of course, trade tensions and policy uncertainty, and of course, geopolitical tensions still with us, we see in different regions. And there are still risks associated with financial markets. In the US, the valuations. In other parts of the world, huge debt challenges. And of course, weather-related, climate-related shocks increasingly creating havoc in many countries. Having said this, there are some upside risks as well. One upside risk is that throughout last year, we saw firms adopting, supply chains adopting, despite these trade tensions, higher, trade tariffs. That might continue, and that could be a pleasant upside surprise. Another important upside risk, this, the AI-related investment translating into productivity gains, and we feel the impact of those productivity gains in general, broader segments of the economy and many more countries. Those are good upside risks if they happen. So let me talk about two downside risks. One of them is the trade-related downside risks. Last year was a big surprise. The trade growth, at least according to our estimates, is around 3.4%. Despite all these shocks, there was quite a bit of course, inventory accumulation and shifting trade advance so you avoid these trade restrictions. That helped a lot. So the trade growth ended up exactly the same as 2024. This year, we expect trade to slow down below 3%, primarily because of this, the inventory accumulation and, very large traffic when it comes to global trade. And our hope is that we will not go below that number because really trade slowed dramatically relative to the average we saw in the previous 2 decades. The other important issue we need to pay attention to this interest rate costs, effective interest rate costs, how much countries are basically paying relative to debt levels they have. And that has been increasing, even though financing conditions are accommodative. And that's a huge challenge, especially in a number of countries, of course, in Africa, low-income countries, and some frontier market economies. Let me turn to this issue of fiscal rules. They're very critical in the context of this debt challenge I mentioned. So when you look around the world, these fiscal rules, the numerical, basically the restrictions you put on debt and deficits and how you basically formulate expenditures, etc., more and more countries adopt these rules. And that's good news in the sense that now you have more than 55% of emerging market developing economies have these rules. In early 2000s, that number was around really 10%. When you look at advanced economies, around 90% have these fiscal rules. Now, adoption of these fiscal rules does not necessarily translate into, of course, miracles immediately when it comes to fiscal balances. But the truth is that they help. They help when you have basically these fiscal rules introduced with good institutions in terms of reducing budget deficits. You see it in the middle panel. It makes a big difference. And it makes a big difference when you adopt these rules. When you adopt the rules during good times rather than bad times, this is a very interesting result. You have better fiscal outcomes over a time period because you do think about the design of these rules during good times, and there is more buy-in. When you basically introduce these rules, when you're back against the wall, you don't necessarily spend a lot of time thinking about the design, and then you are forced to do certain things, and things easily fall apart. Another important issue is that fiscal rules do help when it comes to consolidation, do help when you want to get to the deficit to certain level. In terms of basically having them increases the likelihood of fiscal consolidation significantly, as you see on the right panel. Now, it makes a big difference whether fiscal rules are, sophisticated, whether they are basically simple. When they are basically sophisticated and have all types of enforcement mechanisms, they tend to basically push countries to undertake fiscal consolidation through reducing expenditures. Is that a big surprise? No. When these types of enforcement rules are in place, of course, when governments have difficulties, it is much easier to cut the expenditure than think about revenues. But when fiscal rules are simple, they are basically a conduit to think about revenue reform, tax reform, and of course, you have basically consolidation efforts and better outcomes associated with these types of the revenue route. The design of fiscal rules do matter, and we spend quite a bit of time discussing different options. Let me quickly talk about policies and end the conversation. So, as I mentioned, fiscal rules by themselves are not panacea. Passing the rules on the books, they are not going to solve the challenges. What else needed? You need to have medium-term fiscal frameworks, expenditure frameworks to support these fiscal rules. In a surprising way, countries adopt the fiscal rules, but they don't necessarily, design these medium-term frameworks. It's very important to have, fiscal councils. So the fiscal rules are monitored, then basically commented on when it comes to governments, fiscal success or failures. Transparency is critical, and of course, establishing well-defined functioning institutions are very important when you have these fiscal rules to support the functioning of fiscal rules. Now, increasingly in the World Bank, we focus one important variable. Now, that important variable, jobs. Why we are focusing on jobs? Wherever you go around the world, policymakers complain about the lack of jobs. In some cases, there is growth, but there is not basically enough job creation. It's a big challenge. 1.2 billion young people will join the workforce over the next decade. A number of them going to be in Africa, but there are, huge, basically, masses coming in the context of South Asia, coming in the context of Middle East, North Africa. Youth unemployment is also a problem when you look at Asian economies. If you think about the exits from the labor force, the type of, surge we will see in the entrance to the job market in Africa is going to be largest we have seen in history. And of course, finding jobs to these new generations going to be critical. Let me conclude with 3 messages. The first message is that global economy, of course, has done much better than what people expected in the mid-year. There were good reasons for that. The question is that whether those good reasons are going to be with us going forward. This recovery, good recovery for advanced economies, but not necessarily for developing economies. The second important message is that fiscal rules are very important. In an environment, we have very serious debt problem, very serious deficit problem, but they need to be complemented with all types of policies. The design of these important policy tools, critical. They will require, the careful thinking before implementation, and of course, they will require these supportive measures to be effective. Finally, in an environment of these, non-stop shocks, resilience is critical, and countries need to think about how they are going to create jobs, how they are going to promote economic growth. And there are 3 important points. One, foundational infrastructure investment, human capital, physical capital, digital capital. Second, basically finding ways to improve regulatory frameworks, the business climate. And third, finding ways mobilizing private capital. This is relevant in the context of course, emerging market developing economies, especially relevant in the context of creating jobs. Let me thank again Masoud and your colleagues for inviting us, and invite all of the audience to visit the World Bank for other publications we have. Thank you. Back to you.
Han, thank you. That was very comprehensive and well structured. So it gives us now the basis for moving on to a conversation. Let me start with Joyce, Joyce Chang, if I may. Joyce, we remember a year ago when we were looking at the outlook, there was a lot of sense that things were going to slow down, downside risks were there, the tariffs just come in the US, and not just brought in tariffs, but rethinking the whole approach to international trade and financial cooperation, aid flows, concessional finance flows were cut back from not just the US, but from many other donors as well. So, looking out for the year, the sense was this was going to be a very difficult year, and people were looking for an impact on economic performance. The year went by, and actually, as I had just laid out, economies turned out to be more resilient, the growth rates were strong. Rich countries, large economies, shall we say, which determine the big picture within which emerging markets and developing countries operate, did relatively okay. China slowed down a little bit, but India did well. And US continued to do well. Now, looking forward, again, Ehan had a little bit of a slowing down going forward, but still reasonably good. I want to get your sense of how you explain the resilience that we've seen, and how confident, optimistic are you feeling about the large economies going forward, within which will set the stage, if you like, within which individual developing countries have to operate. So, what's your thinking and your colleagues' thinking looking ahead?
Well, wonderful to be with all of you. I'd like to really emphasize two factors that we've seen in the advanced economies that contributed to having above trend growth, and because we think that these factors are still in place in 2026. The first was the very strong CapEx spending. If you take a look at just our projections for CapEx spending, much of it related to AI, it's in the order of 13 to 15% CapEx growth overall. And just to give you an example, in the US, last year alone, we saw wealth gains that were in the order of $12 trillion. Now, 8 trillion of that came from the equity markets, but 5 trillion of that was from AI spending. So AI spending was something that had not been anticipated at this pace, and we think the pipeline is quite strong for this going forward. Looking to now and just to the end of the decade, looking at the data center, financing needs and the demand for power, we're looking at $5 trillion of investment, by 2030. So we think it's another year where you could see very strong capex growth, and that has really been capital equipment spending growth that has taken hold and accelerated, even as we've seen global hiring stall. The second thing I want to talk about is the fiscal stimulus. This is another year where we see the fiscal stimulus actually increasing in the US, led by the One Big Beautiful Bill, which we think adds about 375 billion of new deficit spending, or about 1% of GDP. And that is business spending as well as personal income spendings, much of it that's front loaded. Just looking at the April tax returns, we think you're going to see a personal income boost by about $200 billion. And you have business investment that will receive similar boost as you have business expensing that can be taken place on a permanent basis. So that's the United States, but in Europe as well, we are seeing increased fiscal expansion from Germany. And we have earlier ECB rate cuts that are also feeding through. So we think Germany's growth, as an example, will go from 0.3 to 1.3%, up a full percentage point, over the next year. We're also seeing increased fiscal spending in Japan as well. So in the developed countries, the two things that really have stood out is the very strong capex and business spending. Also, the boost from having a fiscal stimulus that is taking hold in the U.S., Germany, and in Japan. But we are also seeing some signs of weakness. Like global hiring has basically stalled. The imbalances are forming because of the fiscal spending. And we are also seeing that in the developed country central banks, there's not that much room to cut rates further. We think the Fed is on hold. We don't have any further rates. Based on, we think, growth and inflation both having some possible upside surprises. The ECB also seems to us to be on hold. So Bank of Japan is still in more of a normalization mode, but we think the scope for further easing from the central banks is more limited here. So in sum, still a strong sort of broad-based growth with upside to the forecasts in the first half of the year that could hold. We're looking at global growth this year to come in at around, similar to last year's levels, 2.6, 2.7%, and to be able to hold this going into 2027.
More or less see a continuation of some of the same drivers, but also the same risks. And the risks as time goes on, they're not dissipating. They're becoming stronger underlying risks to the
Absolutely. And the affordability crisis is something that really does need to be highlighted as well, because it's a very K-shaped recovery, because a lot of these benefits are very unevenly distributed because the global hiring has stalled. So we're not seeing the income gains, although we have the asset reflation gains that are contributing to wealth gains.
Thank you. Now, let me turn to Liliana, if I may. Liliana, you've sort of got both Ayhan and Joyce more or less similar perspective on the rich economies, on the large economies. Emerging markets, also, there's always variation across countries, but by and large, it was a reasonably good year last year for them too. At the same time, there's lots of churn in emerging markets, people getting a little anxious about how they're going to cope with the new context within which they have to operate. As you look at Latin America, as you look at emerging markets elsewhere, what are your takeaways for how emerging markets have been performing and are likely to perform going ahead in this coming year?
Thank you so much, Masood, and congratulations, Ayhan and his team for yet another excellent report. It seems to be that the consistency in quality keeps going. So to answer your question, Masood, let me start with the big picture. If I had to summarize 2026 for emerging market in one sentence, it could be that macroeconomic stability in general is improving for a number of countries, but growth prospects remain very modest and much more uneven actually than before. Globally, 2006 does not look like a crisis for emerging markets, right? I would like to make that clear. So the risks are going to be there. You're absolutely right, but I don't see this as a crisis year for emerging markets, right? Inflation is across most emerging markets. Financial conditions, precisely because of what both Ayhan and Joy have been described in the global economy, in general in advanced economies, financial conditions are less restrictive than they were in 2024. And the central banks in many emerging markets finally have some room to cut rates. So from that perspective, emerging 2006 looks better than what many feared a year ago. But that does not mean a return to high growth, which is what emerging markets really need. Global growth, and it has been said already, is slowing slightly. Trade is losing momentum, and I agree with Ayhan that trade will become less supportive for emerging markets because, as he clearly said, much of the strength that we saw in 2025 reflected the front loading ahead of tariffs and uncertainty. So that effect is fading in 2026. But at the same time, fragmentation, industrial policy, and trade barriers remains in place, right? So those problems remain there. So if one were looking for a headline for emerging markets in 2026, could be something like steady but spectacular growth, with, in my view, much stronger differentiation across countries. So I actually think this is very crucial. 2026 will not be about emerging market as an asset class. It will be about country selection. I think that 2026 is going to reward countries that have a credible disinflation path, manageable debt path, and I think most importantly, policy framework that is going to allow easing without losing credibility, right? Because time of decreasing interest rate, but that also have a risk for central bank credibility. At the same time, I think it's going to penalize those countries that are still adjusting, are highly indebted, or actually overly dependent on the external demand. So just to give final words on how do I see countries, there's going to be winners and losers. And from my perspective, I think that two potential winners in 2026 could be India and Vietnam. India, because of its recent trade deals with the US and Europe, which is actually reflecting this multi-alignment strategy, right? I mean, making deals with everybody. But the country at the same time has a manageable external position, has a strong capital flows, and very importantly for growth, has just passed a much needed labor reform, which increases flexibility. And another country that I think is going to look quite well in 2026 is Vietnam, because it will continue to absorb the supply chain reallocations away from China. And it also has a heavy trade exposure. But the diversification helps. And actually, the country also have a strong foreign direct investment that is actually helping too. So I think that would be kind of my views on the group.
Thank you very much, Liliana. So now we're getting country-specific ideas as well from you, which is very helpful. I think, let me turn to Abe. Abe, Liliana sort of got us into this conversation about there are going to be countries that do well and countries that won't do well, and in emerging markets. Yeah, that's always been the case in Africa. And in some ways, one of the things that's always been a bit frustrating for me is how people sort of talk about Africa as one large economy without recognizing that there's 50 countries within which. So, last year, no different. You have 4 out of the 10 fastest growing economies are in Africa, but you also have 6 countries where per capita incomes fell. And the balance between those that are doing well and those that are struggling in Africa. You talk to many policymakers and you have your own analysis, your own team looking at it. I get a sense that there's a little more optimism within the region about the future, that maybe more are thinking that things are going to get better than worse. What's your sense on how we should be thinking about the balance of countries that are making the right decisions and benefiting from the opportunities versus those that are struggling to deal with the challenges in Africa?
Thank you, Masood. Really good to be here. Thank you for inviting me, and very nice presentation, Ian, and really a lot of stuff we can talk about. And thank you, Masood, again, also for putting on the table a source of some frustration for me, also, which is not enough appreciation for the heterogeneity of country circumstances in Africa. So, in discussions with policymakers, I think most, I would say, perhaps, the lion's share for sure, see are a bit more optimistic than they have been the last couple of years. I think it's fair to say that, particularly 2020 through 23 was a period of incredibly damaging external shocks. External environment, I don't think, has been as bad as this for many years for the continent, for many decades. And each shock, I'm talking about here, COVID, the collapse, at least for a period, in commodity prices, all of the issues that Russia's invasion of Ukraine unleashed, the global supply chain disruption, any one of those would have been, a bad enough shock for the region. But the fact that they all happened one right after each other just meant it pushed countries really close to the edge. And I think since then, we have to recognize that the external environment has improved quite a bit, and that has been very helpful. But also, one of the things that we see is that those shocks pushed countries into doing some very, very tough reforms. Not all countries did it on time, some with delay, but some of the reforms that have been undertaken really are seminal and are placing many countries in a better situation to benefit from the recovery that we're seeing in the global economy, even if modest. So I'm thinking here about exchange rate reform in Nigeria, which has been a pressing issue for at least a decade. Exchange rate reform again in Ethiopia. Fiscal adjustment that's taken place across the region really is quite substantial, and it has helped stabilize debt levels, albeit at a higher level. So really very, very important reforms that we have seen countries undertaking. Part because there was no choice. I mean, Ayan was very nicely characterizing what has been happening in advanced countries. I think if there is one lesson that is really, really important for our institutions to learn and for the international financial community also to learn is just how important supportive policies are when negative shocks like this are impacting the most vulnerable countries. I think it's on the back of very strong fiscal monetary stimulus that we saw as robust a recovery as we did in advanced countries. Second, Masood, just going back to kind of how countries are positioning themselves, I think, again, a lot of heterogeneity, a lot of differentiation in circumstances. But I think, again, people are seeing that, this uncertain global environment is not always necessarily a bad time for Africa. At some level, kind of the diminution of interest in the region is allowing countries to do things in a much more thoughtful way, and we are seeing quite a bit of countries expanding their trade partners or building on the expansion in trade partners that have been going on in the past. A lot more scope to do reforms than has been the case in the past. So I think quiet optimism, and we are, from our own projections show also that growth is set to accelerate, on average for the region, and quite a few countries, about half the countries in sub-Saharan Africa in particular, where there's no output gap relative to the pre-pandemic period. We see them going from strength to strength and being able to address a lot of the fiscal challenges that they're facing. I'll stop here.
Great. Thank you very much, Abi. I'll come back to you on this question of debt in a minute. But before I do that, Ehan, I was wondering if I might turn to you. You listened to what the others, excuse me, have had to say. And if you have any reactions to that, of course, very happy to have that. But I want you to, if you might please unpack a little bit the trade point. Because you said trade last year more or less held up to what it had been the previous year. Looking ahead, however, you saw that trade numbers growth was going to slow down. Trade has been a big driver of growth for many countries, but there's also a lot of change happening underneath that aggregate global trade growth number. There's a recalibration, reorientation of trade, much more within blocks and much less trade between different blocks. For emerging markets and developing countries that are not yet sure which block they belong to or will belong to, and whether they should be in any block or not, how should they be thinking about trade going forward? And is that something that they need to be focusing on differently?
Thank you, Masood, and thank you all colleagues. The trade issue is critical, and it is in an interesting way. Trade, of course, surprise on the upside, but your broader point is very, very important. There is fragmentation rather than a collapse in global trade. Last year in April, there was this general expectation, a very serious slowdown. Exact opposite happened. You had this massive front loading of goods ahead of tariff increases and inventory accumulation. And there was also rapid supply chain reconfiguration. At the end, we had basically trade holding up better than what we expected, what others expected. And as I mentioned, trade growth last year was pretty much same as the previous year. This year, we are expecting trade to slow. There is, of course, the impact of these higher tariffs and the policy uncertainty. And the bigger issue, the trade is not going to have the type of impact it used to have. You used to have trade growing around 5% on average. Now you are thinking about range bound between 2.5 to 3.5%, and this year it could be close to 2.5%. And this fragmentation issue, a lot of trade between blocks taking place, very critical. Trade volumes, in a sense, continue to expand, but along increasingly, what I will say, the regional and bilateral lines. But you look at, the goods trade is, of course, slowing as tariff costs build. And the services trade also slowing, especially when you look at, the travel and transport. These have already slowed down quite a bit sharply following the post-pandemic rebound. What we documented in the report, these economies with diversified export destinations, they are faring better actually than those relying on a narrow set of markets. So there are important, risks going forward. These risks are on the downside, and the most important one, a renewed escalation of tensions, especially between the major economies. I think we had this temporary strength. Let's hope that that temporary strength will continue, but in all likelihood, we might end up seeing slower, more concentrated trade, and of course, impact of that for the growth prospects of emerging market developed economies. So this is not the the most exciting narrative. I think what is exciting, Mesut, wherever you look at advanced economies, some of them, emerging markets, developing economies, there is incredible drive to sign trade agreements. We talked about at this forum, the number of trade agreements has been declining. That is actually, that pattern, I think, is slowly changing. More and more countries are trying to engage with trade agreements with other countries, with other blocks, expanding existing blocks, and trying to find ways actually diversify their trade destinations. And that's a very, very welcome news. So in a paradoxical fashion, global trading system remains resilient as more and more countries trying to basically push the frontier when it comes to having trade costs reduced. From the perspective of emerging market developing economies, I think number one, they need to continue pushing that frontier, become members of trade agreements, bilateral, regional, block-wise, reduce the trade costs. Number two, they need to think about how they can reduce internal trade costs, the border costs, and that will require them, in some cases, aggressive infrastructure investment. That's good news. In some cases, thinking about how they formulate their policies at the border, reducing red tape. And third, being careful when it comes to these industrial policies. A lot of these policies sometimes, have restrictive measures when it comes to cross-border trade. So the picture is a mix of strength, mix of, good feelings, expecting better things going to happen. And on the trade policy frontier, push the frontier, liberalize. Back to you.
Thank you very much, Han. And I guess in a way, this push by many countries to look for trade agreements is a way of building insurance in a world where you cannot rely on a single set of multilaterally agreed rules to govern all trading arrangements. So people feel less confident about that. And so they're all trying to do these bilateral, multilateral, plurilateral arrangements to govern their trade flows. And I think it'd be interesting to see how that plays out, as you say, going forward. Abi, could I come back to you and say, push a little bit more on this issue of debt and fiscal? So you sort of said, fiscal, there's been a certain amount of fiscal consolidation pretty much across most countries in the region. This has led to debt stabilizing a little bit, but still at relatively high level. Financial conditions have eased, so market access is also increasing for some countries. How do you see this debt? The debt is still at a high level, and for some countries, it's at a level that's still a cause of both immediate cash flow problems, but also longer-term sustainability issues. How do you see this playing its way out over the next year or two? Is this something that just time and inflation and austerity on the fiscal side will sort of take care of? Or do we need to still think about some action for at least some subset of countries that more directly tackles the debt problem?
Thanks, Masood. Important question. So I think, first, just to be very clear, we have been writing for quite a bit about the really brutal funding squeeze that countries have been facing. We use this phrase to characterize the fact that concessional financing have been declining quite a bit, as you well know. Market financing, the terms of market finance have gone up quite a bit. And then importantly, on the balance sheet of countries, what we have seen, of course, is all of this being reflected in, coupled with, the stock of debt now being higher, we are seeing the interest bills, both for domestic and external debt, being quite a bit higher than they have historically been. What we see is countries having done work on two domains. One, basically compressing spending quite a bit, which is very unfortunate given that most countries have significant development financing investment needs. But on the revenue side, also countries have been trying to do more to mobilize more revenues. So I think quite a bit of effort is going to be needed going forward on both these fronts, but particularly on the revenue side to address the debt question. And I would say that, again, the lion's share of countries have done that and are moving along, that spectrum. As you know, fiscal adjustment anywhere is difficult, but if you actually look at how much adjustment there has been in the region and compare it.
Am I the only one who's lost Abe on my screen? I think we have a technical issue with Abe. While we get Abe back on stream, let me turn to Liliana, if Liliana can. Hi, Liliana. So, Liliana, I wanted to come back to you also on this issue of financing conditions and market access. But actually, I think Abe's come and gone. So let's Abe's there now. So Liliana, I'll put you on hold and finish up with Abe. Sorry, Abe. Carry on.
Sorry, Masood. Internet in Washington, I guess, playing up. Not just. No, I'm not sure where you lost me, but just to make the point that this debt issue is very country and context specific. And our sense is that, depending on how the next couple of years in particular and financial conditions play out, there could be one or two countries that still will need some debt restructuring. But I think the lion's share of the cases that were closer to solvency rather than liquidity issues, I think we've already seen coming. Again, in saying this, I do not want to give the impression that the cost of financing challenge has been resolved. And then lastly, Masood, I think countries are gearing also themselves to living in a world where the cost of borrowing is going to be significantly higher with the dearth of concessional financing. And again, policy-wise, this puts a premium on raising revenues, because the challenge and one of the big difficulties that countries faced in the last 15, 20 years has been not so much investing, but rather not capturing the rate of return on this investment through the tax system. And I think going forward, there's less scope, less room for maneuver on that front, and more revenue mobilization is imperative.
Thank you. Thank you for broadening it out from debt to looking at financing more broadly, because it's not just a question of paying off your debt service. It's a question of being able to have the resources to invest in the growth and
service,
infrastructure you need. So you really have to look at that bigger picture. But I think the other point you just made, I do want to emphasize that the cost of financing is going to be higher, in part because of the cutback in concessional flows, but also because market financing is more expensive than it used to be. And what that means is that you have to be much more rigorous at ensuring that the financing that you do have is invested in projects and in investments that meet the threshold of returns that you expect. And so I guess a bit more rigorous focus on getting the right set of investments and looking at the public expenditure side rather than just the revenue raising side will be part of the package going forward.
Indeed.
Great. Liliana, just coming back to you, if I may, looking at the same set of issues now for emerging markets, financing getting a little bit easier, but at the same time, cost of financing quite high and varying across countries. How do you see the financial stability risks in these countries going forward?
Yeah, you're absolutely right, Masood. Emerging markets have benefit from easier financial conditions. And yes, we have seen this movie before. So as you rightly pose, the right question is not whether inflows are coming in, but what happens when they slow reverse and increase the cost of financing even more, right? And the reversal of capital flows is inevitably in the cycles, right? So from a financial stability perspective, I think that the picture now is somehow better than in past cycles, but not risk-free. So I think that there are like three important differences relative to previous inflow episodes. First is that the source of vulnerability has shifted. In the past, inflows, the way it worked was the inflows fueled rapid credit booms, foreign exchange rate mismatches, and leverage in the private sector. Today, many banking systems in emerging markets are generally better capitalized. Foreign exchange exposure is lower, not in all countries, but we're talking in the general sense. And this reduces the risk of classic banking crisis. Another point is that many inflows have been absorbed without major macro disturbances so far. Currencies have appreciated. Several countries have appreciated a lot, but most of them, the appreciation has not been excessive. Credit growth is not, you don't see huge credit booms in countries, right? The credit growth has been contained. And asset prices have risen, but they again, do not show the excesses that we saw in earlier episodes. And also, another component is that inflation credibility matters. And inflation is under control in many emerging market economies. So the good news is that emerging market is not building the same kind of fragility that it did in the 2000 or in the early 2010. But That, of course, does not mean that risks are absent. They are simply different. In my view, the main vulnerability now is fiscal, not financial sector leverage. So as inflows slow or reverse, in my view, the stress points are going to be more the increasing sovereign financing costs, the debt dynamics, and the interaction between the fiscal and domestic financial markets. And that's a problem for many countries, right? Because many emerging market countries are entering this phase with high public debts and large financing needs. So this creates a risk of fiscal dominance. And so the danger really is not of an abrupt crisis, but a slow erosion of fiscal credibility, which eventually would feed back into financial stability. So to end, what I would watch, in emerging markets going forward are indicators of debt trajectories, not just the debt levels, but the trajectory, how is it increasing, the maturity and currency structure of the public debt, and the credibility of fiscal adjustment paths, not just the announcement. And finally, the build-up of fiscal buffers, because they create countries that have sufficient fiscal buffers also have more room for countercyclical policies. And if you have sort of countercyclical policies, that allows you to manage better any reversal of flows that could generate in the, who knows when.
Thank you. Thank you very much, Liliana. Joyce, we're getting close to the hour, but I do want to bring you in for a quick comment on the way Liliana's characterized the situation, that the financing conditions have eased a bit, the banks and financial sectors are generally in better place in many emerging markets, but there are a buildup of vulnerabilities coming from the fiscal side, and the need for big investments and debt levels being high. Is that consistent with the way you're looking at the situation? How do you see the risks in emerging markets on the debt and financing side?
So we are seeing in the advanced economy a rise in the term premium across the board in the developed markets. I would say that in contrast, in the emerging markets countries, we're looking at inflation that is close to target, fiscal and debt numbers that generally look better than developed markets, and growth that is at trend. So I'm actually more worried about the advanced economies and sort of the long end of the curve, which is really showing some of the concerns about the fiscal dominance and term premium remaining elevated, even if you do have central banks cutting rates. In emerging markets, after 4 years of outflows, we think that inflows are back. The valuations aren't as stretched as they are in some advanced economies, and that the demand actually for diversification has been very strong here. I also think that the weaker dollar will provide makes EMFX more attractive in this environment as well. So the fiscal concerns I actually think are higher on the developed market side than on the emerging market side, just given the size of the overall deficits that we're looking at. In the U.S., north of 6% of GDP.
The longer term structural demands for investments in Europe in building up their military and defense spending, the continuing aging related expenditure entitlement. So all of those are there still as pressures on the fiscal side in rich countries. So that Erhan, last word comes back to you. And I don't want to end this conversation without anything about the fact that you had on your chart FCS, fragile and conflict related states, billion people living there, and you had basically 60% of them are now worse off in living standards than they were before the crisis. Looking ahead, is there anything that should we be thinking that is going to be the prospects also for these countries without much change, or or how do you see the future for these countries in terms of economic performance over the next few years? Ayhan, you're on mute.
In many of these countries, the challenge is the fragility and the conflict. You need to overcome that conflict challenge first to stabilize the macroeconomy. Now, the bigger challenge is to have some kind of institutional stability with that, policy stability. Abebe already alluded to this, the brutal funding squeeze we see, not just, on the concessional side, but foreign aid flows decline very sharply. And in all likelihood, Mesut, they are not coming back. Now, the global community needs to rethink its approach to these economies. And in some cases, as we economists think about this solution, that solution, that goes up to a certain point. It's necessary to think about broader, more coherent approaches. Those approaches have to think about, the political side of these challenges, as well as the economic side of these challenges. And the documentation we have in the report and this decade, pretty much since 2015, actually, things have gone south. Increasingly, not just a decade, we lost many things on the development front. Those losses are building up, and I think you don't solve problems, problems become even bigger. The good news is that these countries, many of them, have incredible upside potential on the demographic front. They have incredible potential on the natural resources front. Whether you are thinking about tourism services, or you are thinking about basically raw materials or rare earth metals, a number of them, they are in very good shape. So all of these advantages need to be translated into better outcomes for the societies as a whole. And for that, I think a global community, we all need to basically rethink how we are approaching and how we can push the envelope.
Thank you very much, Ayhan. Thank you for pointing out. I mean, I think it is a very sobering prospect in terms of what the outcomes in living standards and human welfare are likely to be in many of these countries. But as you point out, there are opportunities, but you have to get the politics and the security right before you can deliver on some of the promise of those opportunities. Colleagues, I think we've come to the end of our hour. I want to thank our panelists. And thank you, Joyce. Thank you, Abe. Thank you very much, Ayhan and Liliana. But Ayhan, I also want to thank you and your team for this annual production that you have give us an opportunity to host here at CGD. And if people have more questions, I'm sure Ayhan and his team will be very happy to engage with them. But for today, thank you all, and have a good rest of the day.
Thanks.
Thank you.
Bye-bye. Thank you.